Welcome, and thank you for watching the pilot episode of our podcast, On the Mark, Financial Literacy with Mark Zinman. I'm excited to introduce Mark to you. Mark, please share a little bit about yourself and what motivated you to start a podcast about financial literacy.
Well, thank you, Monica. But before I do that, let's talk about a couple other things. First of all, I've always wanted to do a podcast about financial literacy, and I'll explain that why in a second. So I came to Monica, our great moderator. I came to Monica and said, Monica, I want to do a podcast. 7 months later, no, I'm just kidding. Monica's a planner, everybody should know. But I have this great team. I have Monica, who's my moderator. I have Alicia, who's behind the camera with the engineering and stuff, and she has this sign that says, slow down when I talk too fast. So I'm all set. I wanted to do the podcast because, first of all, I'm Mark Zinman. I'm a CPA. I have my accounting firm for 38 years, and I've pretty much hope and think I've seen everything from all different stages of life. I've heard all the questions that people have asked. I spend most of my time with small businesses and individuals, so it's easy for me to have gone through all the life things with these people and be able to then basically, let's explain what an accountant does. I'm an accountant, okay? We basically steal from one person and give it to the other. So my best ideas I've stolen from other people. And I say that in a nice way. One of the things I do is I'm in a managing partner roundtable. We always say that we steal from each other. When I say steal from each other, you hear a great idea, you want to try and carry that into your practice. I hear a great answer from a client, I want to share that with another client. So the word steal is more like I'm sort of the center of what comes through our office, and I just think that financial literacy is the backbone of the issues that clients have that they don't know where to get the answer from.
Thanks for sharing that, Mark. Can we get started today with a definition of financial literacy?
Okay. I have my own definition. I think that financial literacy is one of those words that has meaning to different people, like what does a consultant do? Okay, so what's financial literacy? Financial literacy, in my definition, is any decision that you're making in life that has an economic component to it. And pretty much every decision you make has an economic component. Are you going to buy a car or lease a car? Are you going to rent or buy a house? Or you want to finance something or pay cash for it? I mean, there are so many decisions we make every day that have a financial component to them. And understanding the choices that you have when making that decision is financial literacy.
So as a follow-up to that question, tell us why financial literacy matters.
Well, I'll start with a story, okay? So here's my financial literacy story. And I'm going to use my own family as an example. My son, who's now 34 years old, married with 2 kids. He got I have 3 kids. I'm married 40 years. My favorite child, who's my son, has given me 2 grandchildren. The other ones, I'm still waiting for them. They have a chance to become favorites, but they've got to work on that a little faster. But anyway, when Adam graduated from college, and this is 12 years ago, he went to a school in upstate New York, and he was renting his first apartment. You know, it's a great life experience. You get out of school, you're going to rent your first apartment. And he said to me, Dad, is there anything particular I need to do? And I said, yeah, you're going to have to get renter's insurance. And he said, well, what's the best place to get that from? I said, well, it's talking to an insurance person, and, you know, we happen to have a family member who is in the insurance business, Uncle Larry. And so I said, call Uncle Larry, and I think Uncle Larry's licensed. He was in New York. Uncle Larry's licensed in New York. He can help you. So a couple days later, I said to him, Adam, did you call Uncle Larry? He said, yeah. I said, well, did you get the insurance? He said, well, I got to send him a check because I'm a new policy holder, and I got to send him a check. I said, okay, great. A couple days later, we're talking. I said, Adam, did you take care of that insurance? He says, I still got to send a check to Uncle Larry. I said, well, why haven't you done it? He said, I don't have any checks. I said, well, just go to the bank. They'll give you checks. Why don't you have any checks? Well, I don't really write any checks. And I would say probably in this world, we don't call it a checking account anymore. We probably should call it a Venmo account. But he went and got checks. So a couple more days later, I said, Adam, did you send the stuff to Uncle Larry? He said, no. I said, well, why haven't you sent it to Uncle Larry? He said, I don't have a stamp. And I said, what do you mean you don't have a stamp? He says, I don't have a stamp. I said, go to the post office and get a stamp. He said, Dad, I work till 5 o'clock and the post office closes at 5. I said, Adam, you can get one at a convenience store. He goes, you can? I said, yeah. He said, how much does that cost? And at the time, I think it was 50 cents. I said, 50 cents? He said, that's it? That's a financial literacy. There's somebody who's a college-educated person, but he just never had to write a check or mail a letter. And it's something that somebody of my generation would just take for granted.
Great response, thanks. Can you explain what financial considerations are important at different stages of a person's professional and personal lives? And I'd like to get started with young adults, including college students. So let's start with, what are the differences between a bank and a credit union, and what type of account should a student without much money open?
Well, the first thing is that the difference between banks and credit unions in 2025 is that when you go out of our office, the credit union, you'd make a left turn, and the bank, you'd make a right turn. But historically, banks and credit unions have served different purposes. Banks have been around forever. Credit unions were an association. So you had to be of a certain class of people, like in the military or working for a certain company, in order to be a member of that credit union. And that has evolved where nowadays credit unions and banks are pretty much the same thing. And I actually think that from a service point of view, you can get the same thing from your Bank of America or your Wells Fargo or your local credit union. But I think the credit unions tend to cater and have more personal service. So at least that's been my experience, because they cater to smaller accounts and more to individuals and less to businesses. And as far as financial considerations, somebody coming out of college has to be concerned, like my son. Are you renting an apartment? How to rent an apartment? Do you have a student loan? How are you going to pay that back? Do you have a budget? Are you able to spend what you need to spend and not spend more? You're really getting started with nothing. I mean, whatever your parents might, give you a couch or something, but you're going to be buying your furniture. You're going to be getting a place to live. You may not be near home. So there's a lot of new considerations about what to do and a lot of choices. And those choices can be complicated when most people come out and they're on an initial salary. So they're financially limited. So they have to make those choices that are within their means.
Okay, and how about adults in their 20s and 30s? At what point should a working adult consider using the services of a financial advisor, and why?
Well, the first thing I'll say, and it goes to our first class of people as well, if your employer is offering a 401k or retirement plan that has any kind of match to it, you should be investing in it. And why should you be investing in it? Because it's free money, right? You're contributing, the employer's matching to some amount, whatever that amount is free. And most employers, your first association with a financial advisor might be through your employer's retirement plan. Most employers who have retirement plans have some kind of a service, whether it's a website, whether it's talking to a person, that would help you decide how to invest your 401k. And that might be the first money you have to really save, right? People in their 20s and 30s, they may be starting a family. They may be thinking of buying a house. They have different things than, say, the person that up to the end of college. And the biggest responsibility adults have financially is to children, right? If you have a child, then you're going to feel financially responsible for that child, and you're going to want to make decisions that are going to benefit your family. So things like life insurance, what school you go to. I mean, it's all these things are going to be factors in what you are. Let's face it, daycare costs are ridiculous. Okay, so that's going to be that may be a big financial consideration for somebody in their 20s and 30s. But I know a lot of parents that wake up in the middle of the night worried about the future. And one of the things I always tell people is, if everybody had enough money, they wouldn't be asking about money, right? So what you have to do in your 20s and 30s, and what you have to do is you have to just be able to sleep at night. You have to be able to say, well, I put money in my retirement plan. I'm putting money away for a 529. I'm saving money for a house. Whatever your goals are, you're not going to be able to do them all. So just be kind to yourself. And understand something, that life's long and it's one day at a time.
Makes sense. Thank you. So after our 20s and 30s, we hit our 40s and 50s. What considerations become increasingly important at that stage?
So 40s and 50s are the end of, maybe the end, or seeing the end of being able of knowing what's going to happen with your children, right? So children are the most important to us. We want to, every parent has an idea of what emancipation looks like to them. Some parents might say, I want to pay for undergrad school. Some parents might say, well, I want the child to go pay for school themselves. Some might say, I want them to go to grad school and go pay all the way through. So depending on what you and your significant other wants to do with your children, it's going to determine what your obligations are. But at this point in time, you would theoretically know, is my child going to go to a trade school? Is my child going to go to an Ivy League school? Is my child going to go to a state school? And the power in that knowledge is that now you, for the first time in your life, you can quantify the cost between now and what that emancipation is. At the same time, you're saying, well, I'd like to retire when I'm 50 or 55 or 60. So, you have to start thinking about that too. And so, maybe in your 20s and your 30s and even your early 40s, you're worried about your kids. Now's the time that you can start maxing out your retirement plan and start doing that kind of stuff. Think about things like long-term care. Think about things like succession, planning with your, thinking about, that's another important thing, and I'm going to jump off target here. There is nobody who has a child who shouldn't have. So one of the great questions I get all the time is, do I need a will? Okay? And this would be a great topic to talk about in a future episode, but I'll just give you like a real high level. Every single thing goes automatically. So if you have a 401k, you're going to have a beneficiary. If you have a life insurance, you're going to have a beneficiary. A will doesn't change that. All a will does is directs assets to things that you wouldn't automatically go. So let's say, for example, you're single and something happens to you. The money's going to go to your parents. That's how most states work. It's called cheating. It just goes in line. So anytime you want something to be different, you need a will. You definitely need a will when you have children, because you need a will for guardianship and for the taking care of those children as they grow up. So I always tell people, imagine that today you walk out of your house or your office and you get hit by a meteorite. Okay? Is everything the way you want it to be? If it's not, you need to fix it. We don't do wills, we don't do estate planning for the future, we do it for now.
Okay, so you've mentioned retirement planning a bit. How about more mature adults planning to exit the workforce? As retirement nears, what do you recommend they pay attention to?
Well, the first thing I'll say is I hate the word retirement plan. Okay? I've used it a million times. It should be called wealth building. Okay? Because somebody who's in their 20s, who now is 22, 23, go into the workforce, they're going to go enter their employer's retirement plan. They're like, dude, I'm not retiring for like 40 years. What do I need a retirement plan for? So I'll just give you a little bit of a life thought here about across all these things. When you're young, you have a lack of assets. Okay, so you need life insurance to replace the economic loss of yourself. When you're older, your retirement plan, wealth builder, takes that place. When you finally get to the point where you're in your 60s and you're going to think about retiring, the whole conversation shifts. For all the other stages in life, you're saying, well, I make $100,000 a year, I make this, whatever your number is. When you start to retire, you start saying, well, how much money do I need a month to live? And then you start to cobble it together. How do you cobble it together? You cobble it together, well, my Social Security is going to be this much, I'm going to work part-time or full-time. And so where am I going to get the difference? Am I going to get it from my savings? Am I going to get it from retirement? And that's where you start thinking about that. And it gets back to your question earlier about financial advisors. So I said in the earlier one, your first person that you're going to come in contact is probably going to be through your retirement. I'll use the word wealth builder. We'll use that as another markism. Wealth building account is going to be what you're going to have that person. And once you get to the point that you have enough money that you feel like you can't invest it on your own, then you would start looking for financial advisors. And we can have a whole entire show on all the different kinds of financial advisors there are. It's not, your mom and dad's generation, your grandparents' generation, it might have been the guy at Merrill Lynch. And now maybe the person who owns a registered investment advisory. It could be the 800 number at Vanguard or Fidelity. There's all kinds of financial advisor and financial advisory services. And it's always good to build a team around you that will be able to fill in all the gaps of what might be missing.
Okay, so some of what you said provided a great segue to a question that we were asked.
Okay.
Sharon from Ashland, Pennsylvania, wants to know, I'm 70 and I started collecting Social Security. Can I lower my tax burden by working less?
Okay, so I want to attack a couple things on that question. First of all, one of the questions people ask is about Social Security. So I want to just give a brief example, and again, almost everything we're talking about, we can make an entire show over. But Social Security, there's different times in life you take Social Security. If you're fully disabled, you get something called SSI, Social Security Disability Insurance. If you're 62, you can take early Social Security. Your grandparents retired and got full Social Security at 65. Anyone who was born after, I think, 1950, so, unless you're pretty old and you're already on Social Security if you're born in 1950, they were phasing retirement from 65 to 70. So, anybody who's born now is 70, anybody who was born before was grandfathered in. So, but 70 is when you have to start taking your own thing. So, in this case, Sharon, taking her Social Security because she reached age 70, she's still working, and her question is, well, can I save taxes by working less? And the answer to that question is, and it gets into one of those questions that we get asked about that are repetitive. It's different situations, but it's kind of the same question, right? And the idea is like, well, if I make less, I have people, I'll give somebody their tax return result, and I'll say, you owe this much money. Oh, I'm not going to work next year, so I won't owe money. Well, that might be true, but understand that taxes are not 100%, okay? So I have $1, and I go to work and I make $1, and I have to pay taxes. How much can I keep? Well, the worst case scenario, which is the highest tax rate, if you're the wealthiest person in America, it's 37%. Means for every $1 you make, you keep 63. Yes, it costs you 37, but you keep 63. For most Americans, their tax rate is down in the 22% area. And when I talk about tax rates, so when somebody says, and this is another question I get, which is another financial literacy question is, I'm in a 22, I don't want to get to the next bracket. All my money's going to, if I hit the 22% bracket, then all my money's going to be taxed at 22%. If I hit the 24% bracket, it's going to be 24. It's not a retroactive tax. It's a moving forward tax. So when somebody says I'm in a 22% tax bracket, it means the last $1 that you paid tax 22%. And in the case of Sharon, if she's working at a job and then she collects Social Security, and let's say her Social Security is $2,000 a month, that $24,000 is going to be on top of her salary. So that will be taxed. That's marginal. Like, you take your income, right, and you stack it, right? Husband, wife, husband, interest, dividends, capital gains, outside income. However you stack your money, the last money is going to be the highest taxed, right? So if you say, okay, you take the spouse who makes more. I make $100,000. So that's first 100, and then other spouse makes 75. Well, you're paying tax on 0 to 100. They're paying tax on 100,000 to 175, and the rate changes. It's not that they're being taxed higher. The rate just changes because you're stacking. Now, in the tax brackets, married, single, head of household, they change that. But yeah, I mean, that's to Sharon's point. You can save taxes by not making as much money, but you're kind of cutting off your nose, spite your face kind of thing, in a sense that like, well, okay, I saved $10 in taxes, but I now have $600 less to spend.
And Sharon, thank you for that great question.
It was a very good question.
So Mark, as you think about small business owners, what guidance can you offer about managing cash flows, and how do you feel about an owner pulling from a line of credit?
So my answer to this one has definitely evolved over my career. When I was a younger, first starting out my account, there wasn't a single business that didn't live on a line of credit. They might not have had it out. Most lines of I don't know what the rules are exactly right now, but you had to pay it off for 30 days out of a year. So they didn't want you to keep it out indefinitely. But basically, every business had a line of credit. And at the end of the year, when you did tax planning, we sometimes drew from the line of credit as a way to spend down and save taxes, right? Defer taxes, because I could take $50,000 from my line of credits, pay $50,000 of expenses, and I don't have to pay tax on $50,000. But my answer has been evolved over the fact that I believe that businesses have to control their own destiny, and I have lived through the savings and loan in 1990. I've lived through the last, I'm even talking about not lived, but professionally lived through the recession we had in 2010. And, banks change their rules. And one day a bank wants to lend to people who are in this business, and the next day that's not an unpopular business, so you're at the mercy of the bank. If you want to have real control, you have control. So there is bad debt and good debt. So what's bad debt? Bad debt is a credit card bill you can't pay off. Good debt is a mortgage on a house, right? Because one indicates a problem, the other is just a life thing. Nobody's going to have all that cash to buy a house, but somebody shouldn't be buying things on their credit card they can't pay off because it means they're not living within their means, right? At least long term. So a line of credit means that the business isn't living within its means. Yeah, you can use a line of credit if you have a big order and you have to buy inventory for it, or you want to stock up for this, you're in a seasonal, like a clothing business, and you need to buy your spring clothes or your fall clothes. Yeah, you can do it, but it's the same thing as a credit card. You have to be able to figure out how you're going to pay it off within a reasonable amount of time, because you don't want to get to the point where it's out of control and you're dependent. And if if the bank doesn't renew your line of credit, your business is done, right? That's bad. So we encourage businesses to build up their own internal wealth so that they don't need a line of credit in order to operate, except in these few conditions, and maybe there's others that I just mentioned.
Very helpful. All right, I have a final question for you.
Shoot.
What are some strategies that people can use to improve their financial literacy that you'll be discussing in future episodes?
Well, I mentioned a few of them, right? Almost everything's financial insurance, long-term care insurance, when to use a financial advisor. I mean, there are so many I think that you and I, we sat down and when they're planning, what we have, 70, 90 topics. We're hoping, we want this program to be one where we answer the questions from our audience, because the questions I am guessing at what you don't know and want to know. You could tell me, like Sharon, what you know and don't want to know, and I'm happy to answer. That's what I'm here for. So I'm expecting that we're going to there's not a topic out of bounds. There's not a question that is out of bounds, and something, if you're asking the question, somebody else wants to hear the answer. That's got to be your approach when you ask a question. Trust me, you're not the only one who has that question.
All right, so helpful information to end our pilot episode.
Are we ending? Can we clink our glasses?
Cheers.
Yeah.
Chin-chin.
Yeah, we made it.
All right.
Oh,
so our next episode, our next step is for you.
Oh, look, wait. Oh, no. I had to end the thing before my sticker came off. Oh, I'm sorry. We went long.
Tell us about the next episode. We're going to talk about the volatility of the stock market and how it affects non-professional investors. Yes?
Yeah, so I have 2 words for that. I'll give you a little taste. Don't panic, okay? Don't panic.
All right. And you already mentioned, if anyone has a question like Sharon has, you're invited to visit our website, or you can email Mark at onthemark.cpa, and we'll see you next Wednesday. All content provided on this podcast is for informational purposes only. No representations are made as to the accuracy or completeness of information that is presented. On the Mark, its owners, collaborators, and guests will not be liable for any errors or omissions, nor for any losses, injuries, or damages from the use of this information.